a warm welcome to Talking Stocks. I'm Gugulethu Cele. Also with me in studio every week, we're joined by Peter Armitage and Sean Ashton, both from Anchor Capital. Now, they're the experts, and every week we bring you their insightful analysis into JSE-listed companies. In the spotlight is South African private hospital operator Life Healthcare, which recently released its full-year results. Good to have you both, gentlemen. But when we take a look at Life Healthcare, many people only have access to this kind of company when there's something wrong with their bodies. But if you paint a picture for us, who is Life?
So Life Healthcare is one of the premier South African hospital operators, and I think what differentiates them from somebody like Netcare or Mediclinic is that they resisted the urge to forge an offshore path about 5 to 7 years ago. And now you're landing up with a business which is predominantly a South African hospital operator and a fairly unleveraged balance sheet, and they've probably got about a third market share in the South African market.
Is a third market share good when you take a look at their paid patient days?
So I think this business has been an incredibly successful business over the last number of years. I think what Life Healthcare did very successfully is that they reinvented their billing model. They had a new billing model called alternative reimbursement models, where effectively they took on some of the risk associated with pricing for the products that they provide away from the insurance providers by saying to Discovery, we'll offer you a fixed fee for a certain procedure. And as a result, they got a lot of volume share from Discovery. And that resulted in fantastic growth for a number of years. Patient day growth of between 5 and 6% for quite some time. But we're now starting to see that rate of growth is slowing fairly dramatically.
What's driving that though? Peter?
I think the big growth in patient days has slowed because there was quite big growth coming from GEMS, which was the government medical aid scheme. So the actual kind of the traditional private sector, corporate sector, hasn't really grown by much year by year, but GEMS has added on top of that. And that growth has kind of started to decrease somewhat.
There's something else that obviously impacts on patient days, which is the margins, which we'll get up in a moment or two, which also are coming out significant pressure. And I take it that's because of the high cost base.
Absolutely. So I think this is what this business has done very well for a number of years, is manage their EBITDA margins steadily upwards, and they're well ahead of their peer group. So when you look at Netcare South African operations, Mediclinic South African operations, between 21 and 22% EBITDA margins, these guys got up to 28%. And really that was on the back of significant volume expansion, and the way that they delivered their volume expansion was by not building brand new hospitals, but by adding wings onto existing facilities where you're not adding all of the costs. And you're leveraging your revenue over a much more fixed cost base. But I think as volume growth slows, so the laws of gravity start to take effect, and a lot of their cost base is actually above inflationary when you consider that your nurses, which is probably 45% of, or certainly total staff costs are 45% of total expenses. Nurses' salaries go up by more than inflation. And you saw that in their last results. That trend of margin expansion came to an end, and in fact actually reversed somewhat in this set of results.
Not only are they staff quite expensive, but also the equipment that they use. We'll also get a graph up of that, accounting for almost 36% of their margins. It seems like a very challenging environment locally here, Peter.
Yeah, I think there's a number of levers in this business. It's quite a simple business ultimately. It's fairly similar to a hotel. You're effectively renting space and you're providing some services, which is the nurse. Hospitals don't actually employ the doctors, which is quite interesting. People don't realize that. So in terms of the cost base, as Sean says, you've got effectively the rent or the office space, then you've got the nurses. And Life's had some great levers to pull over the course of the last few years. They've kept costs under control. They've increased occupancies, which adds nicely to the margin. And they've been able to kind of kick through that incremental revenue growth. Now the patient days are slowing, the costs continue to go up, there's pressure on putting price increases through. So it's still a great business and still got quite predictable kind of revenue growth coming through, but at a slower rate than the past. So they've been able to turn the dial and squeeze the lemon. But we think now we're probably in a business which is in a 10 to 12% growth phase, as opposed to the 20% per annum that was projected 5 years ago. Management thought they could comfortably grow at that rate. And as we'll talk about later, the valuation of the business hasn't changed. We think the PE multiple that you should place on a business with a lower sustainable growth rate should ultimately be lower.
Well, we do see that the picture of the cost there being painted, and it is a scary one. But earlier you mentioned the international expansion, that they really haven't been very bullish on that. Recently we've had news that they're moving into India as well as Poland.
Yeah.
Are they the laggards?
So I think that they had a lot of levers to pull in South Africa, so it made sense for them to focus on the SA business. I mean, you heard comments from management now that they're focusing on offshore. They clearly see the slowdown that we see in SA. India is not new, by the way. They acquired their shareholding in Max Healthcare, which is the Indian business, in 2011. They paid 850 million rand for a 26% stake in that business at the time, and if I recall correctly, it was something of the order of 40 times EBITDA. So they had to pay heavily for what was effectively buying capacity, because you had fairly new hospitals that hadn't yet filled up. So you were getting a lot of, not much earnings, but you were getting a lot of asset value. But they've had problems with that business. They haven't been able to get the partners to agree on managing it the way that they'd like to manage it. And as a result, the margins and the profitability hasn't come through. So they have increased their stake in that business, but I think without control, it would be quite difficult for them to make the return on their initial capital investment look good. And I think that's the risk with going into a lot of these emerging market regions, is that because it sounds sexy and the growth is there, you have to potentially overpay to get a foothold in there.
Well, we did speak to Andre Meyer recently when the company did publish its results. Let's see what he had to say about the company's international expansion plans. Let's take a look.
We believe that it's essential for us to be able to be in control of the operational side of the business. That's where our expertise lie. In India and Poland, the rationale for the international expansion is the fact that we want to diversify our revenue base outside of South Africa. We anticipate that the growth going forward in South Africa is not going to be similar to what we've experienced in the past. There are a number of factors that will impact on the healthcare environment, in particular in the South African business. And so the strategy for us is to have 30% of our net asset value invested internationally by 2020.
30% of NAV by 2020, is that a realistic outlook from your perspective?
Well, they've just got to spend money.
They've got to spend money, absolutely. And I think it's very clear that he said NAV, not earnings. So it's when you're buying assets and you're paying goodwill, you can create NAV that way. And
Which also implies a low return.
Absolutely.
Because it's, if you're not earning 30% of revenues on the 30% of assets, it means that you're earning less per rand of assets.
What are the risks associated with that, though?
Well, it's, here they know what they're doing. They've got the experience. This is where they've grown up. They know a hospital in a certain area can generate a certain demand. If you offer another territory, picture doing it yourself. It's a bit of the unknown. You haven't got hands-on control. You can't drive to the hospital to sort it out. So the risks are high. You've got to make sure you employ good people in those areas.
Does this also explain the rationale of the partnerships as well as adding on wings? Because earlier on you alluded to the fact that it's a lot more expensive to build a new hospital from scratch nowadays than it is just adding on a separate wing.
Certainly. I mean, in South Africa, that's what they've done so well. So if you build a brand new hospital, you're loss-making for 2 or 3 years, and then you start to make probably a 10 to 15% return on investment by year 4 or 5. But when you build a new wing, you've got a ready demand for that specific stream of revenue that you foresee. And the returns are pretty immediate, and you're not having to add all the central costs of having an additional reception area, etc., a security company that needs to come in. So I think it makes a lot of sense to expand brownfields where you can, rather than building brand new facilities.
Gugu, I think what you've got to remember is a standalone hospital is an 8% per annum growth business. You can get probably 6 to 7% turnover growth or cost increases from your medical aid. You can squeeze costs a little bit, but ultimately, unless you're adding on new rooms, that hospital is going to grow at kind of 8%. It's quite similar to owning a rental property. So for the last 5 years, they've been adding on rooms. Obviously, from a hospital perspective, you can only do so much of that. Then you have to build a new hospital in South Africa, and it's very, very difficult for these big guys to get new hospital licenses. And there's a lot of smaller players out there who are getting hospital licenses, and it's quite clear that the Department of Health is supporting and encouraging kind of black-owned enterprises to get into this space. So the big guys are battling to find new hospitals in new growth areas, and I think the offshore growth and the intentions there are part of that equation.
And it's also a tough regulatory environment. We do have the Competition Commission inquiry into this arena, as well as the National Health Insurance Act, which could be implemented. We spoke to Andre about this and also got his elements to this particular angle and how it might impact his business. Let's take a look.
The National Health Insurance, it's very uncertain as to what is going to come out of the NHI policy. And so we will consider, once we know and have more detail, we'll consider what the strategy will be going forward for NHI. There are, however, also a number of other factors in the country that will impact on our the growth going forward. We're seeing in the South African environment difficult trading condition, and so hence the reason also why we're focusing on international expansion.
This difficult trading condition, won't that also impact on the EBITDA margins? Looking at a graph that will pop up in a moment or two, it does seem as though they're significantly higher than that of their peers in the industry.
Absolutely. So, I mean, when you look at life healthcare compared to Mediclinic, Netcare, South African operations, EBITDA margins for the hospital operations are probably 500 basis points or more higher. Now, there's a couple of nuances around that. I think the first point is that Netcare runs an emergency, Netcare 911, the emergency medical operation, which essentially is a bit of a service to society in the sense that it's loss-making. And Life Healthcare doesn't have nearly the same kind of infrastructure in their business. So immediately that accounts for some more margin accretion. But even if you strip that out, it's still a business that's running at significantly higher margins than peers. And I think that they've achieved more or less the efficiencies that we can expect to see. And any efficiencies that they gain from here, I think, will merely offset the impact of their cost base for key line items going up by more than the rate at which they can put through price increases to the medical aids. So when you look at the actual increases that these guys get in terms of revenue per bed day, it's been running at 6 to 7%. These are not the crazy numbers that you hear out of the medical aids at 10 or 11%. And the reason why those numbers are so much higher is due to higher utilization, not pricing. So when you're getting 6 or 7% price increases and you're having to pay your nurses CPI plus 300 or 400 basis points, that's your biggest cost. So you've already got a squeeze there. Exactly. And you've got to find other ways to actually manage your margin. And it's going to get tougher to do so.
Well, if it's tougher to do so, this brings us to the all-important question that we have up next for you. Buy, hold, sell. Let's get our analyst's view on this particular stock. Peter, from your side, is your portfolio lifeless?
I think it's a good company, can grow 10 to 12%, but if it does that, the valuation is too high. The forward PE multiple in this business is more representative of a stock that can grow 20%. So we don't expect the price to come plunging down, but we think it's a share that will probably underperform over the course of the next 12 months.
So in comparison to its peers then, Sean, not one that you might be in a hurry to pick up?
Yeah, I think it's the most expensive hospital stock in the South African market, and I think a lot of that is the expectations created out of the sustained 20% growth that you've seen them deliver for a while. The market's extrapolating that, and you're seeing it in sell-side research. The consensus estimates are that this business will grow 18% per year for the next 4 years. I think there's only downside risk from that type of a number, and at a forward 21 times multiple, we think it's a bit too rich.
Just to close off with, management still new to the game?
Management's new. I think the key management that has created a lot of the value that you've seen unlocked out of this business over the last 4 or 5 years have largely retired. And yes, you've got a new team in place largely. So it remains to be seen.
So they still need to prove themselves. Well, on that note, that's where we leave it for today. Thank you so much for updating us on Life Healthcare. And I'm afraid that's all we have for this week. But do catch us again next time where we talk more stocks.